Hi, welcome to the next episode of our lectures on the concept of investment appraisal. In the first video about investment appraisal, we spent time talking about the different methods of investment appraisal. We talked about the accounting rate of return, payback period, NPV, IRR. We talked about relevant cash flows, but it was a theoretical explanation about what relevant cash flow should be. We said that for a cash flow to be relevant, whether it is going in or out, the cash flow should be avoidable, meaning that if you don't undertake the project, you would not have to incur the cash flow. It should be futuristic. It's something that is going to occur in the future. It's incremental. It will make you to incur additional costs by undertaking this project, and it involves the movement of cash. So if it doesn't involve the movement of cash, the cash flow is not relevant. So today we are going to have practical illustration on the concept of relevant cash flow. This is important because ACCA, for instance, used to give examiners remark that students find it hard to identify the right kind of cash flow that are necessary to use in estimating the viability of projects. The challenge is not that students don't know the formula or the method to use. The challenge most time is with identifying cash flows and sometimes taxation and inflation, which we're going to do later on. But for today, we are going to look at the concepts of relevant cash flow. And like I said in the previous video or in the introductory video, to download the question that we are going to use, you go to prof-emeritus.com, prof-emeritus.com, this one here. You download it and then download the question from here. You're going to see the title exactly the way you are seeing it here, Investment Appraisal Intermediate Illustration 1. So we'll be having a next video after this that talks about constant cash flow, how if you have constant cash flow, what you are going to do with a payback period, accounting rate of return, NPV, and internal rate of return. Without taking much of your time, let's go straight and look at what we need to do to identify relevant cash flow. You may want to go to the first 15 minutes of the last video to listen to the things I said about relevant cash flow in details. I'm going to repeat some of them, but I will repeat them in the context that it aligns with what we are doing now. So question 1, LCH manufactures product X, which sells for $5 per unit. Variable cost of production are currently $3 and fixed cost is 50 cents. The machine is available, which would cost 90,000, but which could be used to make product X for a variable cost of 250. So what is happening here actually is that they have a product that is already in use by the company, and then they have a new machine. This machine, the benefit the machine will achieve for the company is that once they buy the machine, the variable cost is going to reduce from $3 per unit to $2.50 per unit. However, unit fixed cost is going to increase by $7,500 per annum as a direct consequence of purchasing this machine. The residual value of the machine is going to be 10,000, and then the quantity of the product to be produced estimation is 75,000 units per year. So they expect to earn at least 12% per annum from this investment. Ignore taxation. You are required to determine the relevant cash flow for this project, cash inflow and cash outflow actually. So that is what we are going to do. Here we are just going to identify the relevant cash flow Afterwards, we can use the same question to estimate the respective methods that is associated, especially the net present value method. For cash outflow, there's just one cash outflow for this project, and that is the initial outlay, as you can see here, because 90,000 is what is going to be expended to buy this asset. Then for cash inflow, irrespective of the fact that we are producing 75,000 units of this product and we know the selling price and we know the variable cost, it does not matter to us in this context, because in relevant cash flow, cost that is already passed, like the machine that is subsisting, of course, is not mentioned here. It is a machine that is in use that produces variable cost of $3 per unit. But now that we have a new machine, we are going to save 50 pence, which is 3 minus $2.50. So we are going to save 50 pence per unit, and that is the relevant cash inflow in this question. And the incremental corresponding cash outflow is this 7,500, because of this machine, fixed cost will increase by 7,500. So we have the cash inflows, the savings. You see, the previous variable cost was $3, and the current variable cost is going to be $2.50 multiplied by the units that is going to be produced. So because of this machine, we are going to save $37,500, and that is the relevant cash flow in this particular scenario. Incremental fixed cost, we read it above, is going to be 7,500. So you take that off from the savings we are going to achieve. It means that the annual cash inflow savings for this project for the 4 years that is mentioned is going to be $30,000. Then we are also told that the machine is going to be sold at a residual value of $10,000, and that gives us another cash inflow. Now, there's a reason why I separated the annual cash inflows from this 10,000 residual value, although both of them represent the relevant cash inflow for this question. But if I was going to estimate the net present value, 30,000 comes in every year, but the residual value is only going to come in at the end of the project. Now, don't forget the fact that the question also says that the useful life of the asset is 4 years. I would have taken that into consideration if they asked me the relevant profits, because I need, if I was to do the accounting rate of return or return on capital employed, I need profit and not cash flow. So from this annual cash inflows, I would have subtracted depreciation before I arrive at profit. I said that in the introductory video to the concept of investment appraisal. If you've missed that already, I encourage you to go find time with the introductory video. And then to the next question that we're going to spend a little bit much of time in explanation. We have else is considering the manufacture of a new product, which would involve the use of both a new machine costing $150,000 and an existing machine which cost $80,000 2 years ago and has a current net book value of $60,000. I'm going to explain it here just before we proceed that $150,000 is the only relevant cost in this case. We want to make a new product. However, we have an existing machine which we can use, but because of this new product, there is an incremental expenditure of $150,000 for machinery. So sunk cost, like we said in the introductory video, is not a relevant cash flow. Cost that has already been incurred and is past. This asset that now has a net book value of $60,000, whether we start this new product or not, the cost has already been incurred, and then we don't need to take that as relevant cash flow. So we're going to ignore that. There is sufficient capacity on this machine, which has so far been underutilized. Annual sales of the product will be 5,000 units, selling at 32 per unit. Unit cost will be as follows. So we have direct labor to be $8, and that is 4 hours at $2. We have direct material to be $7, and then we have fixed cost, including depreciation, to be $9. Let's keep reading. The project will have a 5-year life, after which the new machine would have a net residual value of 1,000. Remember that this residual value is always a relevant cash inflow at the end of a project. It doesn't come every year, but it's going to occur at the end of the project. Because direct labor is continually in short supply, labor resources would have to be diverted from other work, which currently earns a contribution of $1.50 per direct labor hour. The fixed overhead absorption rate will be $2.25, and that is $9. So let's look at the labor that is in short supply. If labor is in short supply and we are diverting labor from another work to this one, then the opportunity cost of the income we should have had by using labor at the other part becomes relevant cash flow in this scenario. So we are going to see how we will do it as we progress. The overhead absorption rate would be $2.25 per hour. So this $9 that is here, that is fixed cost including depreciation, is overhead, is apportioned, and all overheads are ignored when it comes to relevant cash flow, especially this depreciation. Depreciation does not involve the movement of cash, so it's not considered relevant in this case. So just note that. I would say something about it again as we progress. Working capital requirement will be 10,000 in the first year, rising to 15,000 in the second year, and remaining at this level until the end of the project, when it will be required. So what happens here is that in determining the timing of cash flows for investment appraisal, what happens is, if a cash flow occurs at the beginning of another year, it is assumed that it occurred at the end of a previous year. For instance, if cash flow is assumed to have occurred either inflow or outflow at the beginning of year 2, for instance, we assume that it occurred at the end of year 1. And then for working capital, generally, working capital is assumed to have arisen in the previous year. So like this one that they said, working capital requirement will be 10,000 in the first year. This 10,000 requirement in the first year would be assumed to have occurred in year 0, and then is rising to 15 in the second year. It is not like it is 10,000 first year and 15,000 second year. No, this 10,000 increases to 15,000 in the second year. So what happens here is that the 10,000 in the first year will be treated as cash outflow occurring in year 0, and the additional 5,000 occurring in the second year will be treated as working capital requirement arising in year 1. We pick the one of year 1, take it to year 0, the one of year 2, take it to year 1. If you don't do it this way, you will mix up your relevant cash flow, and it will affect what you'll be using for estimating the viability of the asset. At this level until the end of the project, when it will be recovered rather. When working capital is recovered, it is treated as relevant cash inflow at the end of the project. The company cost of capital is 20%, ignore taxation. Again, you are required to identify the relevant cash flows for the project. So what we are going to do actually is just to identify the relevant cash flows. We are also not going to estimate anything. If you want to see how these methods are estimated, you can look at the first video or the subsequent videos that will come after this one, because we want to identify relevant cash flow. When we go to the next video, we'll be treating constant cash flows. Then we look at taxation and we look at inflation. Then we bring all of them into a single exam standard question and then walk through. Cash outflows. Like we said, we were supposed to spend 150,000 at the beginning of the project when we want to start buying the machine for the new product. 150,000 will be for a new machine. The 80,000 that was expended on the old machine is not relevant because it's a sunk cost. Working capital will be 10,000 in year one. So we treat it as occurring in year 0 at the beginning of the project. Then it will rise to 15,000 in year 2. So there will be additional working capital requirement of 5,000 in year 2 to make it 15,000. So we treat it as occurring in year 1. Don't forget that cash outflow for working capital is treated as occurring in the previous years. So cash outflow, remember that we've been told from the question, once again, if you don't have the question, just pause the video, go to prof-emeritus.com and download this question. Then you look at the question and compare with the solution, you know. The revenue is 5,000 units of the product will be produced every year, and it will be sold at $32, and that gives me 160,000. Variable cost, the one that is important, is the labor cost and material cost. I am going to ignore depreciation, fixed costs involving depreciation, because the question has told me clearly that it was apportioned. It was an overhead absorbed at 2.25 per hour. So we are not going to include that because it's an apportioned fixed cost. Overhead is ignored when it comes to relevant cash flow. If we were looking for profit, then we could take that $9 per hour into consideration. Then that is the cost. So we have $8 per unit for labor, and we have 7 for material. So 7 plus 8 gives us 15. That's why we have variable cost is 15 multiplied by 5,000 units, and that gives us 75,000. We are told that labor is constantly in short supply. So we're going to pull labor from another location that generates a contribution of $1.50 per hour and bring them to this new product that we want to make. The consequence is that we're going to lose contribution equivalent to this. So it is $1.50 multiplied by 4 hours of labor per unit multiplied by 5,000 units. And that gives us 30,000 contribution that we're going to lose every year from bringing labor to this new location. Having done that, our annual cash inflows is going to be 55,000. Working capital will be released at the end of the project, and that is 15,000. Remember that working capital, 10,000 went out in year 0, 5,000 went out in year 1, making 15,000. Another relevant cash flow that we are going to consider is the residual value of the machine, which we are told is going to be 10,000. If you have all this cash flow in place, then every year from year 1 to year 5, you're going to have 55,000 occurring as cash inflow. Year 5, you have residual value of 10,000 for the machine. Year 5, you have residual value, you have release of working capital of 15,000 coming as cash inflows. All this will be cash inflows, and this one will be cash outflow at year 0, cash outflow at year 0, cash outflow at year 1. When you apply the relevant discount factor, you'll be able to determine if the project is viable or not. Once again, thank you for tuning into this channel. I hope you enjoyed the lecture and you understood. If you have any question, just go to prof emeritus.com. There's a place where you can send us an email, you can text us, phone us, or fill an inquiry form. If you have any question, just drop it and we will attend to it. Thank you very much for tuning in. See you in the next video. Really appreciate your time.